We are in a very peculiar times right now where we are getting monetary easing numbers during a time that our economy is not doing so poorly, to say the least. The backdrop of the US economy is very positive. We are getting 25 basis point in interest rate cuts in July, 25 basis point in interest rate cuts in August, potentially even another 25 basis point in interest rate cuts in December. Unemployment is at 3.6%. The last time we saw such low unemployment numbers was during the first moon landing in 1969. These are outstanding numbers. GDP growth rates are still, for the first quarter, at 3.1%. Goldman Sachs is estimating for the end of the year about 2.5% GDP growth rates, and then next year about 2.4% GDP growth rates. The economy is still growing. Corporate earnings are growing at a rate of about 6% per year. And this is based on a lot of buybacks that companies are doing right now as we speak, because their cash flow is very strong, because their balance sheet looks very strong. The last time that we had an interest rate cut with very similar economic backdrop was back in 1998, where we had low unemployment rates, we had positive corporate earnings growth. And during that time, the following months when we did get eventually an interest rate cut, the market was up about 3.5%. And then a year later, the market was up near or a little bit over 20%. And if we were to look back in time and we will look at similar interest rate cuts during this type of an environment, 80% of the time, stock markets were up about 17% in the following year. Back in 2017, Barron's had an article predicting that the Dow Jones will hit 30,000 points. And they were basing their predictions on tax cuts, corporate tax cuts, and no trade wars with China. So if we were to follow that line of reasoning, and we have about 5.5 years left on their prediction because they were predicting 30,000 points by 2025, that means that stock markets, in particular the Dow Jones, should compound at a rate of about 2% a year, which is pretty pessimistic. However, back then we did not get the predictions of additional interest rate cuts during pretty strong economic times. Therefore, I think it's not out of question that stock markets will do north of 10% going forward in the next 12 months, as long as we have some sort of resolution with China on the trade war front, and as long as companies still growing their corporate earnings at about 6% per year.
Okay, Thursday last week, Slack went public. Like Spotify before them, they IPO'd through what's called a direct listing, and they didn't have to issue new shares. What they did was they were raising additional money, not through a traditional offering, but what they did was they allowed existing shareholders to actually sell their shares to the public. One of the advantages this has is that there's no dilution on their behalf, which is something these investors are always worried about. The day prior, they established their IPO price of $26 a share. In their S1, they've registered for 117 million shares, and their stock symbol is WORK. It was originally SK, but it is going to be the symbol WORK. So what do the financials tell us about Slack? Well, their business is slowing, but they are decreasing the gap in their losses. These companies seem to be using losses from their previous days before going public as sort of venture capital to extend their business and be fuel for their business, and they don't really focus on turning a profit, but rather than growing with the growth strategy. What are some of the stats around Slack? Well, in 2018, their revenue grew by 82%. From 220 million. It's less than the previous year's growth that actually grew by 100%. First quarter, they generated nearly $135 million in revenue, and that's only up 67%. So again, counting for some of that revenue contraction. Q2, they project total revenue between $139 and $141 million, and a 20 cent on every dollar loss per share. The monthly active users, something we heavily look at for these companies that aren't yet profitable, is 10 million active users. They have 500,000 organizations that have used the application on a daily basis. They have 95,000 paid users out of those 500,000 organizations. This direct listing has been anticipated for some time. They've been touted as the email killer. So how does Slack work. They've been around since 2009. They're used primarily within work organizations as a chat tool, but they do have passive management of the tool. They leverage things like chatbots and channels. Slack is a tool of choice for corporate chat. There are a long list of utility companies that seem to be coming public this year that focus on really one main niche, which kind of lack the ecosystem that some of the big tech players like Google, Facebook, and Apple have. But amongst the flurry of IPOs, they're ones that we'll keep an eye on.
After the Fed's meeting last week, when they announced that they would not cut interest rates at this meeting, still a lot of speculation and expectation that they are going to cut rates. About 50 basis points is factored into the market currently between now and the end of the year. We've seen a little bit of fluctuation in the rates, but not a whole lot of difference in the spread. So the 10-year today currently is sitting about 201. The 2-year to the 10-year has still not inverted, and that spread has stayed consistent, about 30 basis points. The short-term rates versus the 10-year remain inverted, and also the 2-year and the 3-year remain inverted.
Two reasons why utilities companies in particular do well when market interest rates are low is one, because of their high dividend. The average utilities company in the S&P 500 pays a 3.2% dividend. So when bond yields are falling below 2.5, 2%, we see investors flock towards these high-paying assets. Another reason is because of these utilities companies, a lot of their capital structure is allocated towards debt because of all the capital they need to raise for buying infrastructure. This is going to stimulate some sort of economic growth. Long-term, market interest rates are actually going to start going up. So we should anticipate that these sectors in the economy aren't going to do as well during these lower interest rate environments.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like the content and you would like to receive it in a timely manner, please become a subscriber to our YouTube channel. You can also call us directly to our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that during times when investors are discounting a decline in interest rates, it is also important to understand the inverse relationships between interest rates and some sectors in the US economy. For example, in the event that the 10-year bond will eventually start going up as far as interest rates, utility companies, consumer staples companies, real estate investment trusts, bond funds can start losing value.